The Narasimham One Committee modernized the Indian banking system. It also made available funds for the banks as it reduced the SLR and CRR. However, even after that, what happened is our Indian banks did now have the capital. So we now had the capital with us thanks to the Narasimham One Committee's recommendation. However, even after having the capital, we were not able to survive the global competition that was there. So now our competition was not ourselves or within the domestic market, but it was the international competition. So now we had to make ourselves better, and in order to do exactly that, the Narasimham Committee II was formed in the year 1998. Now, what has been the reason for formation of this committee is, first things first, high amount of NPAs. Now, what are these NPAs? NPAs are non-performing assets. So, whenever a loan or an advance, if on the loan or an advance, either the principal or the interest, or of course both, are not paid consecutively for 90 days or more, then it is an NPA. So the Indian banking system was having a very high amount of NPA. In some of the public sector banks, the NPAs were 15 to 20%. Which is not good at all. That means that around 15 to 20% of the loans that has been given, the return is not at all coming on from them. Now when the returns will not come, there will be scarcity of funds, the bank will not have money to lend, and whatever money they will lend will be at a higher interest rate because less funds and the demand is the same. So that creates an issue for the bank and also for the economy as well. Then very limited operational autonomy because the banks were still being controlled and the autonomy was quite less. You may argue there was a reason to control. However, the other side of it is flexibility did not exist, and we were not prepared for the international standard. One example of international standard is are the Basel norms. Now, Basel norms are the norms that are given by the BIS, that is Bank of International Standards, of which 62 countries are members, India being one of them. 3 Basel norms have come so far. So to follow those Basel norms, we were not prepared for that. At the same time, the liberalization needed strong and competitive professionally managed banks. If you are liberalizing and giving flexibility, then the bank should be managed professionally. That was also missing. In order to provide all of this, the Narasimham Committee II established. So we will see what recommendations did it give, what impact did it have, and what is the legacy or the impact which is seen in the present Indian economy as well. Also, we will look at some of the criticism of this committee as well. Before we move ahead, an important announcement about the new batches that are going to start at Legacy IAS Academy. So the most important thing is that any batch that you enroll in will have a maximum of 40 students only. The new batches are starting from 3rd of August, regular batch, the weekend batch from 8th of August. This is the best time to enroll if you're preparing for 2027. However, there are subsequent batches as well in the month of September, November, and October and December. Some of the advantages that you will have are listed here. Comprehensive coverage of the syllabus. The game changer is this one-on-one mentorship, regular doubt solving session, regular interactions with the educators, and I've already told you maximum 40 students only. There will be of course daily mains answer writing, test series for both prelims and mains will be there. This makes it the one-stop solution for your UPSC needs, and we have a 360-degree approach for current affairs wherein the entire week's current affairs are covered via live classes. In addition to this, if you're looking for optional classes as well for the aspirants preparing in 27 and 28, we have the most popular and the best of the optional subjects. So we have psychology over here, which is taken by Sagar sir. Then we have PSIR taken by Harshit sir. Then we have also anthropology, the syllabus of which is the most concise, the most least amount of syllabus you can say is in anthropology, taken by Gaurav sir, as well as we also have sociology, which is probably the third or the second most concise syllabus, which will help you. So any of these optionals can be one of the best optionals for you to select for UPSC, as the selection of optional is very important. And if you have done that, you can enroll with us for the optional courses as well, which is starting from 17th of August. Now, if you want to enroll with us, you can download the app or simply call on these numbers to register yourself. Now, let's continue with the committee. So, we have seen the reason of constitution of Narasimham Committee. What was that? Strong governance needed. If you are liberalizing, then the bank should be managed professionally. Better risk management. Now here an important thing is we needed the risks to be identified and managed. And what kinds of risks? Three types of risks. One is operational risk, second is credit risk, and the third is the capital risk. Now why these three risks? Because these are the three risks that are also mentioned in the Basel II norms. Remember, we now needed to abide by the international standard and improve ourselves with respect to international standards. BIS is one such international standard. It talked about the management of operational, credit and capital risk. So we needed a better risk management as well. Then we needed higher capital adequacy. Capital adequacy ratio needed to be higher. Why? Because again, the Basel I norm itself had asked us to have a capital adequacy ratio, right? Not just that, the Basel II norms also, Basel III norms will further increase it. So Basel III norms required us to have a high capital adequacy ratio. That is exactly why we needed to have. Now what is capital adequacy ratio? It is basically the capital that you have divided by the risk weighted assets that you have. So the ratio of this is capital adequacy ratio. You can increase this ratio by increasing the capital, but that's not the right way to do it. You should increase the ratio by reducing your risk weighted assets. That's the best way to do it. This will give us international competitiveness, and we also needed to provide greater banking autonomy as well, so that the control is less and they can do their job freely but professionally. So let's look at first the committee itself. So this is also Narasimham Committee. So again, the chairperson would be Narasimham. Who was he? He was the ex-governor of RBI. So again, the chairperson M. Narasimham. The year of constitution 1998, constituted by, remember, Government of India, not RBI, but Government of India. What was the focus? Second generation banking reforms. Banking reforms were already brought in by Narasimham Committee I. This was the second banking reform that we are talking about. Now what is the objective? To strengthen the banking sector, improve governance and financial stability. These things are very important for you to remember, especially for your prelims examination. Now let us move ahead and understand what were the key recommendations given by this committee. So first things first, they talked about narrow banking. Now what is narrow banking? Narrow means, see, you might have a wide scope of giving loans to a number of sectors. Narrow banking means you narrow down the sectors in which you can invest money or give your money. Now, why? This was done for only those banks which had higher NPAs. Higher NPAs means you are giving the money, but money is not coming back, because you are giving to n number of sectors. So lower it, give it to risk-free sectors only, so that your money comes back. That is the concept of narrow banking, wherein banks with high NPAs should invest mainly in safe securities. And what are the safe securities? The government securities are the safe securities. If you do that, your risk will of course will reduce, because you are investing in government security. Next is government ownership. So this recommendation, again remember, this recommendation was there in Narasimham Committee I as well, but the government had rejected it. However, here again they are saying reduce the government equity in public sector banks. Along with it, increase the professional management and operational autonomy. This was the second recommendation. Then Third was to have higher capital adequacy ratio. I have told you capital adequacy ratio is the amount of capital that you have set aside divided by the risk weighted asset that you have. I hope that is clear. So they wanted to have a higher capital adequacy ratio. Next is banking consolidation. What is this consolidation? Basically merging two or more banks together. So when you merge, right, what will happen is if a bank is not doing well, you can merge it with a big bank which is doing well. So the bigger bank will absorb the shocks of the smaller bank, and together they will have more funds to give out as loans, bigger loans, longer term loans, so on and so forth. So that was the idea behind banking consolidation, wherein merging of weak banks with stronger institutions was to be done selectively. Not randomly doing it, selectively doing it, depending upon the types and natures of the size of the bank. Then RBI reforms. So RBI should primarily do regulation and supervision. It should not have direct ownership and operational involvement in any bank. See, for example, NABARD. RBI had ownership in NABARD, right? RBI had ownership in National Housing Bank. Now, even though Narasimham Committee II is saying over here to reduce its direct ownership, RBI will not completely let go of it. In fact, RBI had sold its stake in NABARD and NHB and made it zero only in the year 2019, right? So it did not completely happen at the time. However, it was the recommendation in 1998 itself. Then, of course, sixth, it's very straightforward, reduce NPA. How do you do that? All other things are going to help us how we do it, but one thing remains, the important thing is reduce the non-performing asset. Now, how do you reduce it? One suggestion given here is establish asset reconstruction company, ARC, right? So ARC is going to do what? Is going to basically take the bad loans or the NPAs from the banks and try to extract some money out of that particular NPA in order to ensure that the balance sheet of the banks are cleaned out as much as possible. Then you had foreign banks. So with respect to foreign banks, we are of course allowing them, but Narasimham Committee says that increase the minimum startup capital requirement from $10 million to $25 million. So the initial minimum means the lowest, it can be more also, but minimum startup capital, which was at that time $10 million, should be increased to $25 million is what was said. Right, now let us see what the government responded. Right, now with respect to the government response, so major policy actions the government brought in to enforce the Narasimham Committee's recommendation. First is the SARFAESI Act. Right, now this basically SARFAESI Act, under SARFAESI Act is going to be the asset reconstruction company. So since this asset reconstruction company will be under SARFAESI Act, what the two will do? See, this SARFAESI Act empowers the bank to recover the secured assets. If someone has taken a loan via putting their security as mortgage, it will give them the right to sell off their security to recover the money that they have given, rather than going through a long-term delayed court procedures and so on and so forth. That is one thing. Second, to operationalize this power, asset reconstruction company came into existence who used to take the bad loans from these banks, try to resolve it by takeover from some other company, by liquidation, selling it off, so on and so forth. Then you have higher prudential norms. In fact, the RBI itself increased the capital adequacy. What happened is the Basel norms. The Basel norm had mentioned that the Basel norm 1 and 2, the Basel norm 1 mentioned that the capital adequacy ratio should be 8%, but RBI said not 8%. I will make the banks have capital adequacy ratio of 9%. So we went ahead of the Basel norms. But in Basel 3 norms, the Basel 3 norms increases it to 9.5, and at that time RBI will keep it at 9.5 only. Then banking consolidation, the merger was given effect. Gradual consolidation took place. In fact, SBI, who had acquired the different state banks of Bikaner, Indore, Travancore, Patiala, so on and so forth, slowly and steadily it started merging those banks within itself. That is exactly why SBI is the biggest of the bank in India, because it has merged those 7 state banks of Travancore, Indore, Patiala, Saurashtra, so on and so forth, plus a Bharatiya Mahila Bank. So that is exactly what was being done over here. And then comes the governance reforms, wherein professional board members, risk management and internal control was internal supervision of the systems and all was done by the banks or enforced in the banks. Now, how did these recommendations shape the Indian bank? Let us understand them. They actually had majorly very positive impact. First we need to understand this and then look at them specifically. Stronger capital position. Remember, capital adequacy ratio is higher. Adoption of Basel norms, all those were recommendations of the Basel norms, so it helped us adopt them. Improved prudential regulation, the regulation was better by the RBI. Greater focus on corporate governance. This is linked to this point. The professional board of directors, so on and so forth. So that leads to greater focus on corporate governance. Consolidation, right? Consolidation, merger of the bank, creating more power for the bank so that they can give bigger loans for a longer duration and better resilience during global financial crisis. Now, since we are stronger, we will have more resilience against any sort of global meltdown that might be there. Okay. However, of course, there is always a scope for improvement. There is always a scope for identifying certain lacunas and improve on them. The same was the case over here. There were certain limitations and criticisms. First things first, there was privatization concern. Why? Because Narasimham Committee said lower the involvement of the government, so everything will become private. The issue with that is you may still have efficiency and stuff, but certain sectors might still be left out. Those concerns, concentration of wealth, all those concerns can be coming over here. Next is the consolidation of the risk. When we talk about the merger, we are taking only positive connotation and thinking that the weaker bank is merged with the stronger bank and now everything is good, but not necessarily. The negative externalities of one bank can be contagious to the other bank as well, as a result of which both of them can have a negative impact as well. So that could also be seen. Next is narrow banking, right? Now the narrow banking made it safer because the domains were less for the banks with high NPAs, but because of that the credit flow will not be good, because the demand goes down because you are narrowing the scope of the sectors to whom you can give loans. So the credit flow might be a concern over here. Next is the issue of NPAs, which still persisted. In fact, it still persisted in 2014-15 also it was there, and only later on it has now started to come down. Next is social objectives versus commercial efficiency. To some extent, again, the social objective completely looks to be ignored. Did you see any social objective related recommendation by Narasimham Committee? There was none. Right, so that is the another criticism of it. However, Narasimham Committee 1 recommended priority sector lending to be reduced from 40% to 10%. The government did not do it. So the government ensured that the social nature of the banks are restored, but specifically anything in favor of social expenditure was not mentioned by the Narasimham Committee. Right. So these were basically the issues that we have seen. Right. Now the question is, what are the impact that we see presently in Indian banking system of the Narasimham Committee recommendations? So all of them that you see are still in force, are still implemented, slight changes, but they are still there. Let us see what. First things first, ARC, asset reconstruction companies are existing and doing their job. Not just that, a similar institution has come up specifically for the public sector banks. So for the public sector banks, something known as the bad banks have come, which caters to only the NPAs of only public sector banks. So its foundation was set by the Narasimham Committee I, which was carried forward by Narasimham Committee II, and when implemented, the government came up with the bad banks for public sector banks on the lines of the Asset Reconstruction Company. They do exactly the same thing but only for the public sector banks. Next is the capital adequacy ratio, which now has to be maintained at 9.5%. Now this is the recommendation of the Basel III norms, which is presently in force, and we are following that by ensuring 9.5% capital adequacy ratio. And remember, Basel I and II norms were enforced on only the scheduled commercial banks, but Basel III norms have been imposed on all commercial banks, that is scheduled as well as non-scheduled. Now not just that, what has also been done is RBI has said that the bank's CRR and SLR can be a part of CAR. That means our banks are already having cash reserve ratio. Cash reserve ratio is the amount of money that the banks, minimum amount of money that the banks have to keep aside with the RBI in the form of cash. Plus SLR is statutory liquidity ratio. It is the minimum amount of money that the banks are required to keep with themselves in the form of cash, monetary, gold, or approved securities, or any combination of these. So these buffer, these are known as reserve ratios. These are known as reserve ratios. So RBI has already said that these reserve ratios are valid for you to keep the money as a capital adequacy ratio, and that is what is being followed by the banks. The NPAs have, it still persisted, but now it has still persisted when 1998 the committee was established. It still persisted in 2000, in the beginning of 2010 also, as I said, up to 2014-15 it was still there in 15-16, but now they are down. So in 14-15 also 12 to 14% of NPAs are there, but now they are back in single digit, which is a better situation to be in. So you can see the legacy, the impact of the Narasimham Committee can be seen in the Indian banking sector. However, one point of caution which the RBI has also said, that the Indian banks are overburdened. Why? Because everyone is going to bank for the money, whereas our other sectors, let's say financial market, is not much prominent. For example, the corporate bond market is not much prominent. People are not investing in corporate bonds, and corporates are also not able to lift money from the corporate bond market, and everyone is going to the banks, hence banks being overburdened. So what we should do is, we should also make investments via different sectors, different fields, different instruments, different markets. That should also become more mature in order to sort of lower the burden on the banks and make them healthier, because if all the eggs are in one basket, then that becomes risky. If the banking system, I would not say collapse, but faces a shock, that can be a big impact. Hence, if we diversify our source of lending and borrowing, that is going to help us diversify the risk and make us stronger. Thank you.